Good morning, everyone. My name is Sam Stovall. I'm Chief Investment Strategist at CFRA, and we are happy that you are joining us for our presentation on CFRA's sector views on the November election and the impact should we see a Biden victory. Let's take a look at who's going to be part of this presentation today. From a consumer discretionary perspective, Garrett Nelson will be talking to us about some of the electric vehicles and other areas of interest in that space. And then Elizabeth Vermillion will be speaking to us about industrials in general and infrastructure in particular. In terms of our agenda, we'll start with what about CFRA? Who are we and why should you pay attention to us? I'll then talk a little bit about painting the backdrop, talking about the elections in the past, the Presidential Predictor, who is it pointing to in terms of a victory? How has the market typically responded during a trifecta or when we've had one party control the presidency as well as both houses of Congress? Then Garrett will speak about automotive stocks and the eco-driven trends, and then Elizabeth will talk about infrastructure opportunities, and then we will open it up for questions and answers. So about CFRA. Well, CFRA blends fundamental equity with forensic accounting research techniques. We produce weekly market commentary, sector insights, portfolio guidance. We cover 11 sectors and 68 industries. We have unique analysis on 1,860 ETFs and more than 15,000 mutual funds. We have qualitative research on 1,500 global companies, as well as quantitative on 25,000 plus. So we pretty much cover the waterfront when it comes to fundamental and forensic accounting activities. How have we done? Well, let's take a look at the next slide. And we can see that a firm called Investars, which does a periodic ranking looking at companies that cover at least 900 US equities, ranked us #1 earlier this year. I mean, I think it would be proud just to be in the top 10, but we in May of this year were ranked #1, so we must be doing something right. Let's take a look at the next slide. What we find is that what we do right is that we have no axe to grind. Research is all we do. We have no conflicts because we don't manage money or we don't make trades. We do not have an asset management arm. As a result, we don't create financial products that compete with our clients' offerings and thereby potentially clouding our ability to provide unbiased ratings. Let's go to the next slide. So I'm going to be talking a bit about the upcoming election, looking at history, seeing if history can provide some sort of a guide as to what will happen, as well as how the markets might perform once a decision has been made. Let's take a look at the next slide, which basically says that from March 23rd of this year through September 2nd, we went through a recovery period. In only 5 months, the S&P 500 retraced the 34% that it lost during the February 19th through March 23rd bear market. That was the third fastest recovery since the crash of 1929. Primarily because of large and swift fiscal and monetary stimulus, Wall Street analysts looking across the valley in terms of 2021 GDP and earnings forecasts. We then surged more than 60% off of the March 23rd bottom, the second strongest of any bull market, initial bull market since 1932. And we also saw the S&P 500 growth index outperformed the value index by a measure that was never seen before in history since the mid-1970s when these two indices were created. As a result, we probably got a little bit ahead of ourselves. The market then ended up retreating out of exhaustion, triggered by worries about the second wave of the COVID virus, the fiscal stimulus that continues to be delayed, worries about September, and also the obsession with October, and then the mounting concern over what might happen to the stock market, to taxes, etc., should we end up with a Democratic trifecta. Well, if history can offer some guidance, it will tell us that no decline from exhaustion after initially getting back to break even has resulted in a new bear market. We've seen declines of anywhere from 5 to 15%, with the average being around 8% or similar to what we just experienced. History then tells us that the bull markets proceed once again and last an average of 36 months. So indicating to us that we've got 3 years ahead of us, at least in terms of enjoying this new bull market. Let's take a look at the next slide to see what does history normally tell us is likely to happen in the upcoming election. Well, the stock market is typically a pretty good barometer of who will be elected. Since World War II, whenever the market rose in price from July 31st through October 31st, it pointed to a re-election of the person or the party 82% of the time. Whenever the market was down in that 3-month period, it actually indicated that the party in power would be replaced. This was correct 88% of the time. Question about this time, well, the market is up actually 5.1% through last night. So looking at face value, this presidential predictor would imply that the sitting president will be reelected. Let's take a look at the next slide. What we find here is, if you remember your Greek mythology, like the messenger from Marathon, whenever the market got back to break even from a prior bear market, it tended to tumble from exhaustion. So the first grouping, bear markets, the start and end going back to 1929. When did we recover all that we lost in that prior bear market? And then when did we slip into a new decline of 5% or more? On average, it was a little less than 2 months. And then the decline that we experienced averaged 8.3%. This time around, it was minus 9.6%. But encouragingly, what we found was that the next bear market really was delayed as little as 4 months, but as much as 109 months down the road, with the average being 36 months and the median being 24 months. But it doesn't imply that it's going to be smooth sailing over the next short term or even long term. As the next chart shows, October is a month that tends to spook investors. Let's take a look at the next slide, please. Here what we have is the October obsession regarding volatility. Since World War II, looking at the standard deviation of monthly returns, what we find is that the volatility in October has been 36% higher than the average for the other 11 months, and about 11% higher than the second highest month, which is January. So don't be surprised when there's additional volatility in this month. So as Betty Davis once said, fasten your safety belts, it's going to be a bumpy ride. But there's something good that actually can come out of this volatility. As we see in the next slide, we look for conclusions to pullbacks, corrections, bear markets that normally take place in the month of October. A pullback, a decline of 5 to 10%. We've had 59 of them since World War II. 35% of these have concluded in October with that capitulation sell-off, tied with June, but ahead of every other month. In terms of corrections, 10 to 20% decline. We've had 23 of them, and October has had the greatest percentage of conclusions to corrections take place in its month at 22%. And with bear markets, 38%, more than twice what has been experienced in other months of the year. So you could say this is a good sign, because if the loose hands finally let go of their holdings, then maybe the sell-off has finally run its course. But investors might be worried a little bit about, you're correct, Kessie, go to the next slide, please. Might be worried a little bit about, gee, if the Democrats take control of the White House, does that mean that the market is going to sell off? Well, looking at annual performances going back to World War II, the market has actually done better under Democratic presidents, gaining an average of 11.1% in price versus a near 7% gain for Republican presidents. But of course, some people say, well, wait a minute, it's the House that controls the purse strings. So if spending is so important for this economy, shouldn't we see who is in control of the House of the Representatives? So the next slide actually shows us that these data are reversed, that a Democratic House has posted an average return of close to 8%, yet a Republican-controlled House has seen the market rise by 10.5%. What does this tell me when we have two conflicting pieces of information? Kessie, let's go to the third slide. There we find that you can find data to support almost any position you wish to embrace. So one of my favorite buttons reads 40% of all statistics are wrong. But let's take a look at real history that says maybe we shouldn't worry too much about a Democratic trifecta. Looking at political scenarios since World War II, meaning unified government where the president and both houses of Congress are of the same party, a unified Congress where the unified Congress is of a different party than the presidency, and then a split Congress. What we find is that in the 22 years since World War II that we've had a Democratic president and a democratically controlled Congress, the market gained 9.8% on average versus 8.7% for all years. What's more, it offered the best FOA, frequency of advance, or basically batting average. How many times was it up? Well, it was up more than 3 out of every 4 years. So history would basically imply, you know what, maybe it's not so bad after all that Wall Street tends to take advantage of opportunities, and it's just happy that the uncertainty of the election has concluded. So maybe that will happen this time as well. Digging a little bit deeper into the next slide, what we find is that whenever we have had an election that then resulted in a Democratic trifecta, that's happened 6 times since World War II. Yes, we saw a decline in November, possibly because of the surprise of the sweep. This time around, maybe there could be a reaction because Joe Biden has indicated that he would like to raise taxes on individuals making more than $400,000, as well as corporations. Could we see investors decide to take some profits in 2020 at a lower tax rate than risk the chance of having to pay a higher tax rate in 2021 and beyond? So once we get through this negative surprise to the sweep, December traditionally is higher, possibly because of the seasonal optimism that usually surrounds December. And as we look into the next calendar year, the market has done very well, up 5 of 6 times, gaining more than 10% on average. So history would basically say you don't really need to fear who is in control of the government, because the market is a barometer of economics, not necessarily of politics. Let's take a look at my final slide, which says traditionally, what are the sectors that tend to be the outperformers in the July through October period leading up to presidential elections? I have shaded in green, energy, financials, industrials tend to be the better performers on average. Staples, communication services, and real estate tend to be among the weaker performances on average. I say that because 6 observations are not statistically significant. So what I'm finding is that you were better off looking to where the strength is now. And isn't that interesting? But 2 of the 3 strongest sectors are the ones we're going to be discussing today: consumer discretionary, industrials, and tech. So to help us understand what are the opportunities in the consumer discretionary sector and in automobiles in particular, I now turn it over to Garrett Nelson.
Hi, thanks, Sam. So one area that we think could do very well in the event of a Biden win is the area that I cover, automobiles, but more specifically, electric vehicles. Why? Well, I'll delve into Biden's proposals in a minute, but Biden has said his policies would create 1 million new jobs spread across the auto industry, from manufacturers to suppliers in infrastructure. Importantly, he's also said his primary intent is to benefit union workers with his proposals. And obviously the Midwest states such as Michigan and Ohio that comprise the heart of the US auto manufacturing industry, are going to go a long way toward deciding the election. It's also important to note that the UAW endorsed Biden fairly early on in April, so he has the support of the auto industry's largest union. But we think Tesla and automakers with largely union workforces likely will be among the biggest winners. Tesla, of course, is 100% non-union, but the Detroit Three, General Motors, Ford, and Fiat Chrysler all have a high percentage of union workers. Looking at the global market and trade policy, with USMCA now in place, we think the biggest change to the status quo could be a shift in trade relations between the US and China, as trade policy would likely be less hawkish, as in fewer tariffs and fewer tariff threats. The next slide shows Biden's policy proposals related to the auto industry, and the first two are the ones we think would really have the greatest impact on EV demand. Number one, tax incentives to stimulate EV supply and demand. Biden hasn't provided specifics on this, but he says he wants these to be targeted incentives to help increase both the supply and demand of EVs made by domestic unionized workers, and that there will be both tax credits to encourage consumers to purchase more EVs and tax benefits for manufacturers to produce more EVs. Secondly, he wants consumer rebates for the trade-in of older, less fuel-efficient vehicles for new EVs. If that sounds familiar, it's very similar to the Cash for Clunkers program that was implemented in the early days of the Obama-Biden administration. Thirdly, he wants to make government fleet purchases EVs. So he wants to make the roughly 3 million vehicles that the federal government purchases regularly, such as mail trucks, buses, etc. He wants to make those all electric vehicles that are manufactured in the United States. Number four, he has proposed increasing investment in EV infrastructure and research. He wants to build 500,000 new EV charging stations. You heard that mentioned in the first debate a couple weeks ago. And that's a really big one, because currently there are only about 27,000 non-residential EV charging stations in the United States. But obviously with politics, what a candidate says and what actually happens are often two different things. But it's important that if this were to happen, that would represent almost a 20-fold increase in the number of EV charging stations, which is just massive. And then finally, it's important to understand that Biden also wants to raise the U.S. corporate tax rate from 21% to 28%, which will have a negative impact on earnings, of course, not only for the auto industry, but for all corporations who pay taxes in the U.S. He also wants to impose a 10% offshoring penalty surtax as a mechanism to protect U.S. manufacturing jobs from moving abroad. Moving on, one thing that's important to understand about EVs is that despite all this attention surrounding Tesla and EVs in general, EVs accounted for only about 1.9% of the total new vehicles sold in the US in 2019. And in the chart on the right here, you can see the growth of EVs over the last decade from close to 0 to 1.9% last year. And it's estimated that EV market share will continue to grow to more than 20% by 2030, or more than 1 in every 5 new vehicles sold in the US by the year 2030 will be an electric vehicle. On slide 26, this chart shows Tesla's US vehicle sales growth over the last several years, and the red line shows their share of the US EV market. And as you can see, Tesla has become the dominant player in the US EV market. They accounted for 58% of all EVs sold in the US last year, which was up from a 14% market share 5 years earlier. And we think Tesla's market share is going to continue to grow when we get the data for 2020 because of the introduction of the Model Y, where they had first deliveries in March, and the fact that basically no other EV model has sold very well recently. So we think they will continue to pick up market share over the near term. Slide 27 shows what's happening with battery costs over the last decade. And it's really incredible how much lithium-ion battery costs have come down. You see here, they've come down almost 90% to about $150 per kilowatt hour. And this is important because the battery is by far still the most expensive part of an electric vehicle. A battery generally accounts for between 1/5 to 1/3 of the total cost of an EV. And the rule of thumb is that an EV's cost really reaches parity with a gas-powered vehicle at $100 per kilowatt hour, which will probably happen in the next 4 years. Battery costs will come down from about $150 to $100 in the next 4 years, we think. And so this combination of falling battery costs combined with innovations to improve battery range are what's really going to drive continued market share gains for EVs over the next decade. Moving on, consumers who purchase qualified EVs in the US are currently eligible for a $7,500 federal tax credit. And that tax credit begins to phase out after a manufacturer sells 200,000 EVs on a cumulative basis dating from January 1st of 2010. And so far, only 2 companies have hit that threshold. Those companies are Tesla and GM. So we think that Tesla and GM would stand to gain the most from new or expanded credits under any potential legislation that might pass, because the fact that tax credits are not available for their vehicles have really placed their EVs at a disadvantage compared to all other manufacturers which are coming out with new EVs. And as far as what form any legislation might take in the event of a Biden win, we think it could incorporate elements of 2 bills that were introduced in Congress in 2019. Now, both bills went nowhere, but one was the Driving America Forward Act, which actually had some bipartisan support in the Senate. And that would have expanded the federal EV tax credit by allowing an additional 400,000 EVs per manufacturer to be eligible for a $7,000 tax credit. While the other bill, Clean Cars for America, was sort of like a cash for clunkers program for EVs, as I mentioned earlier, from the early days of the Obama administration. And this was a pretty massive bill, $400 billion bill that would provide rebates to consumers to swap out their older gas-powered vehicles for the purchase of new electric vehicles. This next slide shows the current number of non-residential EV charging stations in the US, which totals a little over 27,000. And you can see the breakdown by state here. Almost a quarter of all the charging stations are in California. But Biden says he wants to increase this number by 500,000, which I said would be a 20-fold increase in the number of charging stations. And we think that would really give a boost to the adoption of EVs, particularly in the states where EVs have been slower to gain traction, especially many of those states in the right-hand column. But looking at the bigger picture and what a potential Biden presidency might look like, the biggest change we see is that trade relations between the US and China probably would not be as contentious. We think there would likely be fewer tariffs and fewer tariff threats as trade policy probably becomes less of a focus under a Biden administration. There would also be risk of the China Phase 1 trade deal falling through and the expiration of existing tariffs. And what we've seen is that the tariff tit for tat over the last few years has really led to the increased regionalization of auto manufacturing, which is what the auto trade data shows. For example, finished automobile exports from the US to China have fallen dramatically, as have exports of auto parts from China to the US over the last 3 or 4 years. But very importantly, we see no risk to USMCA. That's a 16-year trade deal that went into effect on July 1st of this year. And we view USMCA as a significant positive for the North American auto industry that really makes the continent more competitive as a whole in the global market. And over the last few decades, the global market has really changed dramatically from the rise of China, which has gone from being a very small player to becoming the world's largest producer and consumer of automobiles. Slide 32 shows exactly how much the global auto market has changed since 1994, which was the year that NAFTA went into effect. Annual auto production has fallen by about 11% in the US over that time, in Canada by 17%, by 14% in Western Europe, while China's production has increased by more than 1,800%, and global auto production has grown by 83% over that time frame. But we think USMCA really helps strengthen the competitiveness of North America as a whole in this new global landscape that's really changed so dramatically over the last 2.5 decades. And so what if Trump is reelected? Well, we think EV market share growth would continue, but at a slower pace than under a Biden administration, because we view the growth of electric vehicles as a long-term secular trend that will continue regardless of who's president. Battery costs are likely to continue falling, and EVs will probably reach parity with internal combustion engine vehicles by the year 2024, as shown on the earlier slide on battery costs. Also, I'm sure many of you saw California's recent ban on the sale of new gas-powered vehicles, which will start in 2035. The question is now whether other states might follow, but several other countries around the world have announced similar bans in the next decade or two. And under Trump, tax credits and other incentives are less likely, so we just probably wouldn't see the level of subsidization of EVs as we would under a Biden administration, in our view. And here are the companies that we think would be winners from a Biden win. Under auto manufacturers on the left, we think Tesla would benefit as the dominant EV player, as an EV pure play. They would benefit from expanded tax credits and also the possible rebates, which would really stimulate demand for electric vehicles, but also from the massive build out of charging stations across the country. We also put GM and Ford in that category because we think we should take Biden at his word that he wants the domestic manufacturers with largely union workforces to benefit from any legislation. And I didn't list Fiat Chrysler as the other Detroit 3 member because we think they would be less of a beneficiary than either GM or Ford because they're in the process of merging with the French automaker PSA Group, which will greatly increase their European exposure. And that merger of equals is on track to close in the first quarter of next year. On the right, under auto suppliers, we think the 3 biggest winners in our coverage universe would be Aptiv, ticker APTV, Borg Warner, ticker BWA, and Visteon, VC, because those are the companies with the greatest exposure to green technologies and vehicle electrification trends. So those are the second derivative plays on increased demand for electric vehicles, if you will. And then on this final slide of mine, clients frequently ask for our updated thoughts on Tesla because it's such a high-profile, rapidly evolving, multifaceted story. So I wanted to just provide some high-level thoughts on the company. First, I think their recent battery day really fell a bit short of investor hopes for a more immediate needle mover. The stocks had a massive run-up over the last several months, and so the expectations were very high. We were very impressed with the battery day. The battery technology they unveiled we think will really help widen their competitive advantage over other EV manufacturers, which is already very wide to begin with. When you look at the fact other automakers have really had to move mountains to come up with an EV capable of driving 300 miles even on a single charge, and that's what the Ford Mustang Mach-E is, which a vehicle that will start shipping here in the next few months. But at that battery day, Tesla unveiled a new vehicle model, the Model S Plaid, which will have a range north of 520 miles. And they've started taking reservations for that vehicle, which will be available late next year. Also, I think there's some concerns. I don't think investors really want the company to sell a $25,000 electric vehicle with full autonomy. When you listen to Elon Musk, it's clear that he has a bigger mission than just the profitability of the company. It's really an environmental and sustainability mission. And I think, he talked a little bit about the $25,000 vehicle with full autonomy, but we think investors really want them to innovate and create pricing power for their vehicles in the marketplace on both the electric side and autonomous side. And so, we think, there's lots of legitimate questions surrounding, what the margin would be on that type of vehicle, but, we suspect they would not be very, very high. So, we don't think that's really what investors want to hear, is them essentially, giving vehicles away at that price point. There's also the debate over Tesla's regulatory tax credit revenue and earnings quality over the last 3 or 4 quarters. Tesla qualifies for zero emissions regulatory credits in certain areas such as California and in other states. And that's really been a huge driver of these massive earnings beats that they've reported over the last 4 quarters. And I think what's important to understand with that is there's essentially no cost associated with that revenue. So when you see that, like last quarter, they posted $427 million of regulatory tax credit revenue, it flows directly to the bottom line. And so it's a huge earnings driver for the company. And these are tax credits that they are selling to other automakers who don't have the level of EV exposure that they have. So it's a huge competitive advantage to be in the position that they're in. Third, we think the year-to-date stock price run-up itself is the most positive recent development in the story, because it's given Tesla a massive cost of capital advantage over other auto manufacturers. And I can't stress that enough. I think it's still an underappreciated part of the story and explains, this huge run-up in the stock and while it continues to move higher. And then finally, we think the stock's addition to the S&P 500 is an eventuality, and that's probably the number one reason to not be short the stock right now. Obviously, Tesla fell more than 20% the day after the committee announced their most recent rebalancing, and Tesla wasn't among the companies that were being added to the S&P 500. So we think it's just a matter of time until they are added, and that it's very plausible that the stock could regain that 20%, regain much or all of that lost market value on an announcement, which could be made at any time. The committee can add or subtract stocks from the index at any time. So, so with that, thank you very much for your interest, and I'm going to hand it off to Elizabeth, who is going to talk about infrastructure, because of course we'll need roads to drive all these electric vehicles on and bridges to drive them over. Thank you.
Thanks, Garrett. So like Garrett just mentioned, we're going to shift into talking a little bit more about the infrastructure side and implications if Biden is elected, and we'll also look at some implications if Trump is reelected for a second term. So looking at the next slide, we're going to just talk about the current state of America's infrastructure. So the story of U.S. infrastructure really is one of decades of underfunding. So on this slide here, you can see grades that are produced by the American Society of Civil Engineers, And so this report comes out every 4 years. The most recent one was in 2017. And the overall score given for American infrastructure was a D+. So it really highlights the dire need for improved infrastructure. On the slide here, you can see some of the areas that are that rate have some of the worst grades. Rail does have one of the better grades with a B. Airports are plagued with old technology. There's aging terminals, and as a result, there's a lot of choke points at major hubs. Drinking water with a grade of D is negatively affected by aging pipes, and this leads to actually about 240,000 water main breaks a year. Bridges are improving, and because the proportion of bridges that were rated poor fell to about 7.6 in 2018, and that's down from about 9.4 in 2017. But on the other hand, train infrastructure really is degrading. Right now, about 2/3 of train tunnels and 1/3 of the control systems are rated as poor. And then a lot of the energy grid right now has aged really well far beyond its expected 50-year life expectancy. So this is something that is extremely important for, as Garrett mentioned, the electric vehicles and the charging stations that are needed for those, as well as for 5G build out. And then, so just overall transit infrastructure really is aging, and the inadequate access across different metropolitan areas is really plaguing both public and private transportation right now. So looking at the next slide and funding surrounding infrastructure investment. So right now, most infrastructure needs are severely underfunded. As you can see on the chart here, the funding here is a combination of both private and public funding. And one thing that we really want to highlight is that the need for funding is not in question. Everybody agrees, both parties, everyone agrees that infrastructure spending is extremely vital and important and lacking. But really what's happening is the sources of funding are coming into question, and nobody can agree on getting a bill passed. And so really what we see as the solution to all of this is there needs to be some kind of a federal infrastructure spending bill. States and localities can't make up this funding gap. So right now, funding is most robust for surface transportation, so that's roads and bridges. But still, even though this is the area that's getting the most attention and funding, over 50% of needed work is still unfunded. So while the US does have some of the most resilient infrastructure systems in the world, these conditions are deteriorating as this infrastructure continues to age. Our infrastructure right now is built in line with guidelines that were introduced at least 50 years ago. And so of course, these have become inadequate just due to daily usage, as well as more frequent extreme weather events that we see today. So as I mentioned earlier, some states are stepping up to start to counteract or to counter these investment shortfalls. Right now, about 31 states have raised their gas taxes. So that was between 2010 and 2019. And then some states have legislation that allows for the indexing of a gas tax. So state action, which we think needs to be coupled with federal funding levels, it's slowing right now. And this downward trend in highway spending is a bit of an issue. And we still think that it's below the level required for an efficient operation of our national highway system. And we'll talk about that highway spending bill in a little bit. So current bipartisan efforts to draft and pass an infrastructure spending plan have really been running into roadblocks when the question of the source of the funding is coming up. So both parties do agree that the spending is absolutely necessary. The issue is really coming from where the funding will come from. And one party disagrees with the other party's source of funding. And so then the next party pushes through a proposed bill, and kind of the same thing comes up, the question of where's this funding coming from? So on the next slide, we're going to look at various sources of government infrastructure spending. So government infrastructure spending is broken into state and local spending and federal spending. Within federal spending, there's also direct spending and then spending that is transferred to states. So right now, half of federal transportation spending goes towards highways, air, and rail. And then the next largest target is our water infrastructure sources. Right now, or under the Obama administration, state and local spending peaked after the Great Recession, and then it declined throughout the rest of his term. So that was in recovery efforts. And then as soon as recovery kind of started to take hold, federal spending trickled off. Direct federal infrastructure spending peaked in about 2012, and then it continued to decline. And then under Trump, you can see direct federal spending has been fairly stable. This is something that would have surprised, I'm sure, probably everybody if we were back in 2016 when Trump was talking about infrastructure spending throughout his campaign. It seemed like something that was going to get done very early on. So it's definitely a surprise that it's stayed flat throughout his first term. So back, I'm still on that last slide there. Federal investment affects the economy mainly by changing the overall demand in the short term, and it gradually boosts private sector productivity in the long term. Some investments in infrastructure start improving productivity soon after they're made, and other ones like R&D take a lot longer to see those impacts actually out in the market. So some of these investments do have a stronger effect on productivity than others. And then one way to finance infrastructure spending more efficiently, we believe, would be to change the nature of tax preferences that the federal government is offering to the buyers of municipal bonds, which are often issued to finance highways and other construction projects. Some tax-exempt bonds are a relatively inefficient way to subsidize state and local government investment in infrastructure, and this is because the revenue cost to the federal government can actually substantially exceed the interest cost that is provided to the state and local governments. So now moving on to the next slide, we have covered the current state of infrastructure and some more general aspects of funding. And then now we're going to review some more detailed specifics about infrastructure spending, recent spending legislation, and recent trends. So US infrastructure spending has hovered at about 2.5% of GDP over the last few decades. And so what this means is that as the economy is growing, federal spending really isn't keeping up. According to the ASCE, who publishes that scorecard that we looked at on the first slide, we're poised to underinvest our infrastructure by about $2 trillion between 2016 and 2025. So that comes out to about $206 billion a year of underfunding. Even though state and localities' real spending has declined from 2007 to 2017, they still do account for about 77 to 80% of US public infrastructure spending. So that's in contrast with federal government that saw its real spending also fall over the same period, and it accounts for just about 23% of US public infrastructure spending. Total real spending nationally has fallen in the last decade, and that's from about $450 billion in 2007 to about $440 billion in 2017. And so here we point out that there was a surge in 2009 and 2010, and that's due to the Recovery Act after the Great Recession. But this bump in infrastructure spending was short-lived. Spending levels have increased only marginally in the last 5 years. And this is even as states and localities have really improved their fiscal health since the Great Recession. And so this is really highlighting that, federal spending is something that is going to be needed if we're going to reverse this trend of declining national spending. Spending on infrastructure, transportation infrastructure has fallen about 1.4% since 2007, but where there have been some signs of a rebound in the last 5 years. So spending on transportation, so this includes highways, mass transit, rail, aviation, and also water transportation. It continues to account for the largest share of public infrastructure spending, and it has dropped from about $300 billion in 2007 to about $299 billion in 2017. So overall, smaller drop than total transportation spending. And this decline is driven by mostly the highway spending, especially on new capital projects. But then the improvement side is that real spending on transportation that is increasing recently is due to states and localities. They're really driving that increase. And so you're seeing a surge in operation and maintenance spending, and that's capital projects for mass transit. So looking at the next slide on major infrastructure spending bills that we've seen in the last 10 or so years, as well as the recent efforts that there have been to pass some kind of a federal infrastructure spending plan. So looking back to 2009, the American Recovery and Reinvestment Act, so this was prompted by the Great Recession, this act included $80 billion in infrastructure spending. So 48 billion of that was for transportation and mass transit projects. 31 million was for modernizing federal buildings, and about 6 billion was for water projects and water infrastructure. So this was also a jumpstart for the alternative energy industry, and it really showed support from the federal government towards clean energy efforts. So about $17 billion in renewable tax energy cuts were a part of the act, and then $5 billion was geared towards weatherizing homes. And so something that we want to point out here is a point of comparison to the CARES Act, which was passed in response to the COVID-19 driven recession. The CARES Act has zero allotted for infrastructure. So that's something that is in stark contrast to the last kind of recovery bill that was passed. In 2015, the Fixing America's Surface Transportation Act, commonly known as the FAST Act, was passed, and it was a 5-year commitment that actually just expired at the end of September. So this act addressed the aging and congestion of our transportation systems. It increased highway and transit spending, but it still fell short of the $400 billion that we estimate were needed over the 6 years since the bill was passed to keep traffic conditions from declining further. This bill also did not address how to pay for longer-term transportation programs. It was kind of a short-term mindset. And additionally, the FAST Act required the U.S. Department of Transportation to lead efforts to develop coordinated and concurrent environmental reviews across federal agencies. So it really is kind of keeping in line with that shift towards, when we're doing infrastructure updates, a little bit more of a green mindset, not just pushing through infrastructure as maybe it had been done in the past. So heading into the 2016 election, the Republican Party campaign platform really heavily emphasized federal infrastructure spending, but quickly into the presidency, it became clear that the plans that were proposed, really only a small portion of that funding would be from the federal government. Seemed to be like it was going to be about $200 billion of the 1 to 1.5 trillion spending plan that was outlined. The rest of that infrastructure spending was going to need to come from private sources. And so while we saw this focus on a federal infrastructure spending plan as a huge opportunity, really both parties kind of, it fell through, and no bill was passed. So we think that that's something that has really, something that the industrial sector really could have used. And so throughout President Trump's first term, infrastructure has continued to age and degrade and break down. In 2019, the America's Transportation and Infrastructure Act was introduced. It has not been put to a vote in the Senate, though. This bill outlines about $287 billion from the Highway Trust Fund, and that's over 5 years of investments to maintain and repair roads and bridges, and to overall just keep the economy moving. This 5-year funding level is about a 27% increase above what was a part of the FAST Act. And like many of the other proposed spending plans that we saw during President Trump's first term, the sources of the funding were what were lacking from this bill, and really the roadblock to it moving through Congress. And then in July of 2020, a $1.5 trillion bill called the Moving America Forward Act passed in the House. So this effort was to rebuild our nation's roads, railroads, and schools. And so the bill puts about $300 billion into repairing bridges, about $130 billion into schools, and that's specializing in low-income areas, and then more than $100 billion into building or preserving affordable housing, and a similar amount into expanding broadband internet access. So right now, Republicans are opposing the legislation, and we think that that's really driven by the amount of measures that are aimed at fighting climate change that are wrapped up into that bill. The Trump administration has also criticized this bill, again, with the issue of where's the funding coming from, and then also for not including measures about accelerating permitting progress for new infrastructure projects. So that's another thing that comes up a lot in the discussion for infrastructure spending from a federal side, is the where's the funding coming from, and then will permitting be accelerated? Generally speaking, Republicans are more interested in accelerated permitting, whereas Democrats are a little bit, or geared towards a slower permitting process so that there's time to take into account environmental impacts. So in looking at the next slide, at the FAST Act, which really been a major overhang lately as we've come to its expiration. So the hopes that Congress would pass an election year highway funding bill to replace this act were really dwindling leading into September as it was expiring. It was really looking unlikely that anything was going to happen. And this is, a bit frustrating because the need to address infrastructure is really clear. The report card shows that there are issues there. Both presidential candidates, both parties really agree that infrastructure spending is something that's very important in our infrastructure. The issue is getting worse and worse, and we'll start to have economic impacts soon. So we really think that the FAST Act, replacing the spending from the FAST Act, is something that's going to need to happen as soon as the election is over. And so then looking at the campaign platforms for both parties, we're going to go a little bit more in depth, starting with the Republican platform on the next slide. So CFRA sees direct infrastructure implications in all of these following aspects on the next two slides for the Republican platform. So there's a new era in energy. So this is a focus on modernizing the electrical grid. Here, the Republicans think that this is best carried out by states. There's environmental progress, and so here the focus is shifting environmental things to the private side. America on the move, so this is where we would hope highway spending and you'd see more of that in road infrastructure spending come through. Then looking on the next slide, technology, so here the goal is to simplify the tax code and then pave the way for that 5G build out where there's a lot of infrastructure implications. And the electrical grid, again, the goal here is low cost rather than an environmental focus. So looking at the Democratic Party platform, again, the infrastructure implications here, investing in the engines of job creation, combating the climate crisis, and then pursuing environmental social justice. The Democratic Party's platform's infrastructure spending is really woven into a green initiative, lowering greenhouse gases, and really just focusing on the environmental impact of the way that infrastructure spending has gone about. So then looking at that next slide, as Garrett mentioned, there's a lot of focus on electric vehicles, and we think that there's a lot of industrial and infrastructure company opportunity to build out the infrastructure to support the electrification and the roads that all of these vehicles are going to drive on. And eliminating that carbon pollution from power plants by 2035. So a lot of the industrial companies obviously run power plants that produce a lot of greenhouse gas emissions. So this is going to be an area of focus that's going to be very challenging for these companies to overcome. But I think that just the focus on the technology there makes it possible. So then looking at the next slide, just looking at some of the sub-industries who we think have the most impact on infrastructure spending. So that's building projects, the construction and engineering sub-industry. So those are more of like the project managers who carry out the construction projects, construction machinery and heavy trucks, of course, Caterpillar, Deere, equipment companies like that. Electrical companies have a lot of work in the 5G and the electrical grid build out. And then the railroads, the trucking companies, the distributors, those are all the companies where we see everything Garrett talked about with electric vehicles, hopefully something that can be leveraged for these companies and have that technology applied to heavier payloads and really reducing the greenhouse gas emissions from the supply chain movement that keeps America running. And then finally, we're going to take a look at some where we see sub-industries winning under either presidential candidate winning for the next term. So we see just kind of in general the industrial sector hopefully winning under either president if there is an infrastructure spending bill that's passed. And then 5G is something that both parties are continuing to pursue. And then, so looking at the next slide, we're going to just highlight some sub-industry and company-specific areas that we see benefiting from a Biden victory specifically. So here we're highlighting the construction machinery and heavy trucks, and then construction or the industrial machinery companies. So here we see a lot of benefit from focus on the electrical grid, from rejoining the Paris Agreement, and from infrastructure spending that's going to increase demand for companies like Illinois Toolworks, United Rentals, and Caterpillar. We think that under the Biden plan, they'll have an improved opportunity to expand their electrical machinery and their electric vehicles offerings. And then looking at construction machinery or construction materials, we have a positive outlook on this sub-industry over the next 12 months. We expect that construction spending, both on the public and the private sector, is going to continue growing, especially in 2021. And so though these, the economic cycles really affect the level of spending on these projects, we think that there have been a little bit more stability and predictability from funding from the government of all levels, and that's excluding a federal infrastructure spending plan right now. In the past, the uncertainty, tight labor markets, and project delays have depressed construction activity, but we think that at this point the need has kind of reached a tipping point, and some of this work that's been held off for a while is really beginning to, projects are beginning to happen just because you can't wait any longer. So going forward, we think that any infrastructure spending is really going to broaden the demand for these materials companies. So with that, I'm going to pass it back to Sam and see if we have any time for a few questions.
Thank you, Elizabeth. Thank you also, Garrett. Yes, we got some time for questions. And Elizabeth, while you're still warmed up, let me ask you the first question. Where I can assume that a Biden tax increase will help pay for infrastructure in the period ahead, but where will the Republicans get the money for infrastructure?
Yeah, so that has been a question throughout President Trump's first term. And really, if you think about the proposals that have come up for a federal infrastructure spending plan while he's been in office, the bulk of the spending has that burden has been put on private industries, private companies. And so there's really not a lot of a further answer as to where those private sources are. The big takeaway here is that under a Republican infrastructure spending plan, comparatively very little, $200 billion is still a fair amount of money, but a small percentage of that total spend would be coming from the federal government. So that's sort of the private side that's coming up with the bulk of the spending. That's really where the burden is, and I think that that's where a lot of the pushback from the Democratic side is looking for more details and who is going to be providing that $800+ billion of spending, because that's really where the difference in closing that spending gap is going to come from. So not quite sure who the ultimate sources of that are, but the lack of federal spending is definitely something that is up for debate between the two parties.
And do you see it taking place starting in 2021 right away, or something that will be delayed over the coming 4 years?
After the way that the last 4 years have gone, it's it's kind of hard to say either way. The rhetoric around infrastructure spending has definitely accelerated again, so it makes it seem potentially more likely that something will kick off next year. And I think if Biden were to be elected, just the climate and greenhouse gas emissions goals that he has are more urgent. And so I think some kind of residual infrastructure spending could come from that, making it a little bit more likely that infrastructure spending could see an uptick in his first year as opposed to the first year of President Trump's second term.
Great. Okay, Garrett, time to wake up. I got a question for you from one of our listeners. I know you don't cover Albemarle, but the question is, what do you think about this company? What do you know about this company? And what about other lithium producers?
Yeah, so Sam, that's a good question. I can't comment on that. I'm not following the battery industry directly myself, so I'm just in autos, and I track what's going on in the battery industry, but can't comment specifically on Albemarle.
Okay, well, that was an easy question, but anyway, so let's go with, there are several startup EV manufacturers. Some have gone public and some have plans to do so. Do you view any of these companies as a real threat to Tesla?
We think, Tesla has really established a first mover advantage in electric vehicles, but there are some interesting companies, startups that are coming out with models fairly soon. The two I would probably single out are Rivian and Lucid Motors. Rivian has two models coming out in 2021. One is a pickup truck. It's called the R1T. One is a vehicle that looks kind of like the Range Rover. The model is called the R1S. I think both of those will sell fairly well, but just because the truck and SUV category is so popular with U.S. consumers, and they're both pretty attractive looking vehicles that have generated a lot of buzz in auto circles. They also have pretty compelling price versus range specs, which is what I talk about so much with electric vehicles. But both of those have a starting MSRP of around $70,000. Their range is about 400 miles or so. These cars go 0 to 60 in 3 seconds, and they have good towing capacity. So, but the initial launch of those vehicles was recently delayed by about 6 months, but they'll be available around mid next year. And then Lucid really stands out because the specs, also because of the specs on their vehicle. They have a vehicle called the Lucid Air, which has also generated a lot of buzz. The range on that vehicle they're claiming will be 517 miles, which is right up there with Tesla's Model S Plaid. And their CEO came from Tesla. He was actually the chief engineer of the Model S. So they have good management. They also have the backing of the Saudi Public Investment Fund, which made $1 billion investment in the company last year. So the thing I would say is that there's been a very, very long list of failed EV startups over the last decade or two. Fisker, Bright, Coda, Spiker, Detroit Electric, Aptera. Those are just some of them. And if a startup's initial vehicle models really don't gain traction with buyers, that company, as we've seen, just might not survive. But I think, what I really look for with all these new startups are three things. First, the experience and credibility of management. Secondly, their funding sources. And then third, the specs of their vehicles and, overall attractiveness of their vehicles to determine how they might sell with consumers. And, one thing that's really amazing is that, last year in the U.S., only one electric vehicle that was not a Tesla product sold over 10,000 units. So, basically all other EVs have really, really struggled to sell in the U.S. Basically anything that's not a Tesla. So, but there's certainly, it's a rapidly changing landscape. There will be more IPOs and, a lot more competitors very soon.
Okay, well, a lot of the focus is on Tesla, on the electronic vehicles themselves. But what about those that support the EV marketplace? Are there any EV charging station companies that you can invest in, or anything else that, in a sense, would be in the support side?
Yeah, so that would probably fall under infrastructure. There, if you look at the traditional automakers, they've really relied on third-party companies to build the charging stations. They haven't, there's been some investments here and there, but there hasn't been the level of direct investment as we've seen with the Tesla with their supercharging stations that they're building all over the place. So, it would be more on the infrastructure side, and I think, but that 20-fold increase in EV charging stations that Biden is pitching as part of this platform, we do think is really going to be a game changer. But it'll probably be in my coverage universe of auto suppliers, there really aren't any companies that are in the business of building the charging stations. But that could change, and I would look to maybe some of the battery companies out there to really provide leadership. Panasonic, LG, those types of companies to really be behind that growth in charging stations.
Well, good. Okay, well, with that, we went a little bit over, but I figured there were some good questions that needed answers to. So thank you very much, Elizabeth and Garrett, for answering those questions, but also for giving us your opinions on the EV and the infrastructure areas and opportunities, no matter who gets elected president. One last thought, question that we see here is, how do we learn more about CFRA? Well, obviously, going to our website. If you go to CFRAresearch.com, you can learn more about the offerings that we have. You can also sign up for a free trial to our MarketScope Advisor platform. Also coming up on October 14th, we have a webinar, Thematic Investing and the Reopening of the Economy. So going to the website at the bottom on the left-hand side, you can register by going to CFRAresearch.com/Globex-theme. Also, you can visit our webinars site so you can see what other webinars are coming up. So with that, I will then say thank you to everybody for tuning in. Thank you to Garrett and Elizabeth for giving and sharing of your knowledge, and we will see what happens over the next couple of weeks.